Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our econ show. Now, luckily for those that have been watching, this one's going to be a little bit shorter, which is thankful. There's not as many slides. There's only 97 this time instead of our normal 138 or so. But we're going to break it into our normal 5 segments. And the first one, I want to talk about elevated debt levels and how that's changed and why that's making the weather issues worse. And just a quick summary of why. Well, when you have disastrous weathers, whether it be drought or flooding, you need money. You need money to fix the problems, whether that's, importing more food, supporting farmers or people that are being hit by the drought, or just repairing all of the damage that we've seen from the monsoons and beyond. And that creates more problems given how much subsidies and things that came in during the pandemic, making it that much harder this time around. And one of my friends actually said, he's like, I don't want to panic or anything, but it seems like what's happening right now is like the apocalypse is upon us. And I laughed and he was making a joke about it, but you look at it and it's like, man, it's like everything is hitting all at once. And those are some of the things that we've been discussing. Then in the next segment, we're going to go into the expectations for the Fed. We have the Fed meeting coming up, but we wanted to really look at what is happening there and then the weakening real income and spending, because obviously, we want to adjust for inflation and look at what is happening. Then we're going to finish off in the U.S. Looking at the leading indicators, because some of them are a bit mixed. There was a little bit of a reacceleration in August, but as we had been saying, we thought manufacturing was going to stay in growth, but services was going to stay in a decline, and that's so far what's playing out, and we want to go through that again. Then we're going to go into Europe and look at how economic and consumer confidence continues to falter, and what does that mean for economic growth. And then we're going to round out with China. So we're going to touch on the drought, how things have gotten a little bit better, but also the bond situation, because everyone, the bond problems and the fixed income and maturity issues extend well into next year. And we want to look at some of those problems that are not going to go away, but are going to continue to be a residual issue as we go into next year and then even into 2024. So with that being said, Osama, who is our trusted analyst, he helps put together the slides. He writes great reports. He creates some of the charts for us. He's in Pakistan, and it's unfortunate. Luckily, for him, he's safe. He's in a place that is obviously getting a ton of rain, but not seeing the flooding. And I thought this was a great chart, putting into perspective just how bad this monsoon season is. And whenever there's a massive drought in one area, you always have to kind of assume that there's a massive flood in another. And that's where it's always interesting when you look at Mother Nature. And there's always those extremes on either side. And here's just one of them. When you look at Pakistan I thought this was shocking, because remember, the monsoon season continues. Like, this is the beginning of the monsoon season that is going to maintain well into September. And this gives you an idea of where 2022 is versus the average. And this is why so much water is creating so much damage. But this is only continuing to create the problems. Because remember, Pakistan has some of the highest inflation it's ever had, and it's 47. I think it's the highest inflation in 47 years. But it's not just them. Like, you look at Indonesia, and this is linking back to the EIA show. When we were talking about the driving data and how things look pretty good in Asia. But now Indonesia, there's more riots because they are cutting subsidies and raising gasoline prices. You start looking at some of these nations, and we're going to talk about it in segment 5, where the PMIs have actually finally rolled over. And that's the extremes that we think are going to continue as those subsidies fall off. But also countries that are facing either extreme drought, extreme rain. There's so many issues that are going to continue to rise up from this. And it's obviously complicated further because when you look at Pakistan, they lost their whole cotton crop. So that's going to hit us in terms of given this is Under Armour, so it's not really made of cotton, but it's going to make cotton more expensive. It's going to impact. There's a lot of polyester that comes from Pakistan, and there's a lot of these issues that are going to continue to reverberate through the system, and that's going to make things worse and increase unrest, increase those problems because they're going to need more money. The IMF just wrote a loan. The U.S. is giving some aid, and hopefully other countries follow because there's going to be a lot of need in these areas that continue to have struggle. Now, as we said in the EIA show, we wanted to talk a bit more about Iraq, and this filters down into some of the issues that we're seeing. Again, there's been extreme drought again in the Middle East. That has hit Iran hard. We wrote an article. I wrote an article about it the beginning of this year. And these are things that continue to propagate through the system, but the different factions. So I wanted to break the different factions into. So you have the Sadr, who announced he was stepping down from politics August 29th. But then you have the Shia Coordination Framework, the SCF. So the SCF is seen as a proxy to Iran, and Sadri, and as we were saying, the Sadrists, who were the ones that were rioting, those are the ones that are anti-Iran, or I should say they don't want Iranian influence. So this is where you continue to see the feuding Shia factions, and the Sunnis are, again, they don't like either side. They are more on the Sadri side, obviously not as much, but the Sunnis also want Iran out. So that's somewhere they can agree, and that's, again, creating more problems, more confusion and anger. And that's where we had this huge breakdown. So at least 30 people were killed and 700 wounded in clashes in Baghdad, August 29th and 30th. And a lot of this was in the green zone. And again, the green zone was a safe haven that the U.S. had created. And this is, again, the problems that are continuing in terms of getting some of this balance. But Iran continues to face these challenges in terms of maintaining influence, which is why the likely thing is they're going to be able to do a deal with Europe that's going to unlock about 70 million barrels in floating storage between oil and condensate. So the question is, are they going to try to discount some of those barrels? And by they, I mean OPEC. But at the same time, you have a lot of this unrest and uncertainty. Now, Iraq is a big country. Right now, it's not really impacting a lot of the oil exports. Now, Basra is what we have to look at, which is in the very southern tip of the country, because that about 960,000 barrels a day of crude flows through there. And that is where there is a fairly sizable Shia faction that is against the SCF and against Iran. So again, if there's continues to be, that's going to be the area. I mean, obviously Baghdad is important, but when you look at actual flows, that's going to be a pivotal piece. So that's the crude side. Pakistan is obviously the cotton side. Then you have China, and you have some of these other places that are experiencing severe drought, impacting food. So then we look at the extreme drought hitting 12% of the U.S., and you get an idea, as we said before, there's a huge amount of the U.S. that is under either severe drought, exceptional, extreme. So the drought monitor shows over 35% of the country is experiencing at least a severe drought. Not that unique going back 2 decades, but still worrisome as food inflation is uncomfortably high and consumer confidence remains low. And this is only going to make that worse. As we said before, corn yields lowest since 2019, lowest in the fourth lowest in the last 20 years. So again, this is making those situations worse. And food is, again, a big piece of it. You have the geopolitical unrest. So, and the reason why we just pick on Iraq for a second is because that is just all of the shortages of food and water and the inability to get jobs and the unrest. That starts to come out as COVID again fades to the background. You're seeing it in Indonesia, we've seen it in Sri Lanka, we've seen it in large parts of Latin America, and it's only going to continue to expand. I mean, not even to mention large parts of Africa as well. And these are the problems that we continue to address, to try to address and highlight when you then factor in all of the debt that's come through. So this is interesting because you're looking at advanced economies and emerging market economies. So obviously inflation was through the roof in the 70s and 80s, but then we started to, get things under control, and we got very comfortable issuing debt. And it's not just the US that was issuing debt. And this is when people look at the fixed income market and say, oh, well, the fixed income market, because equities are going down, people should be rushing into treasuries. But you have to think about the sheer amount of treasuries that exist, the sheer size of debt that is sitting out there. I mean, and then if you consider where the economy is, and again, these are the ratios of debt to GDP. But as GDP falls and debt continues to rise, that ratio increases exponentially. Now, advanced economies have the benefit of of safety. The U.S. has the benefit of the reserve currency. Emerging markets don't. And emerging markets have a lot of that debt denominated in dollars, making their situation worse. So how are they going to stimulate? So they need to buy more grains because of drought. They need to bring in more dollars because of massive flooding that has destroyed infrastructure. Farmers have lost complete crops. They're going to need support. With what money? With what debt? And again, this is why we're watching all of this culminate, and why. And again, I've only been doing this since 2020, but I've been doing this on the street since 2006. This is what we tried to highlight: is if you continue down this road, it will end in tears, because you need to have the ability to spend, but you need austerity. You need tightening at the end of easing. And if you just look at the trend, there's never been tightening. There's never been austerity. There's just been, the market tolerated this, so we can do more. Oh, the market tolerated that, we can do more than that. Oh, and again, you see the propagation that continues until it pops. No one knows when. And again, you could have said this in the 90s, in the 2000s, in the 2010s. But again, at some point, the saying was in 2011, the can is light and the foot is strong, which just means you can kick that can a far way down the fairway. But then I come out and say, eventually, at some point, you're kicking it in front of a brick wall. And no matter how hard you're kicking it, you're just not getting anywhere. And that's the law of diminishing returns. That's where we sit today, in my opinion. So now when we turn over to Africa's dependence on Russian fertilizer imports, you're getting an idea of, as the issues continue, and again, coming back to the food side, Africa depends on a lot of Russian fertilizer. When you look at, where are they going to get it? Can they replace it? If they can replace it, how much is it going to cost? And again, that's where we continue to see these prices, because the world's top fertilizer exporters, Russia, China, Canada, US. So you're looking at some of the biggest. China's gotten absolutely decimated by drought. How much of that fertilizer could actually even be created? And we're going to talk about in segment 5, how they've had to cut runs. They've had to cut industrial usage because of power shortages. Plus, are they keeping it internal? Canada, US have been able to export, but then Russia's obviously, and then Belarus, given what is happening with Ukraine, this is why food is such a huge problem, and why we don't see this being any better. And we're going to launch, I did a quick update on why, as C6 Infrastructure Partners, the PE fund that I own, why we're investing in fertilizer companies, and we highlight one of them, and then again kind of build off of the problems that we continue to see and not going away. But from the U.S. perspective, the U.S. dollar still remains the dominant currency in the global reserves, and that's not going to change. And if you go back through history, it's always been who has the navy has the reserve currency. So that's why the British pound was so big when it was. But It's started to adjust, but how much can it really adjust when the dollar continues to be the preferential treatment? That gets the preferential treatment because of trade, because of security, because of what the U.S. has. But as we continue to tighten, the world has gotten used to and gotten drunk off of just perpetual QE, which just means that you've had an easy amount of liquidity in U.S. dollars available. But as that goes away, to maintain that level, well, what do you have to do? Emerging markets are selling treasuries to bring in dollars. And you might say, well, why are they doing that? Because treasuries get paid interest in dollars, so just keep the dollars coming through that way. And that's 100% accurate. The problem is they need more today because of the extreme issues. So they're selling those bonds to bring forward the principal because they're trying everything they can, putting more downside pressure on our bonds. And because there's just so much U.S. debt out there, there's a lot to be sold. And who is your next incremental buyer, which is what I always come back down to. When you're looking at this, whether it's a home, an equity, a bond, who is your next incremental buyer? And is that buyer willing to pay more or less than you? And that's always where we continue to see. So as we said in 2020, when we did the USD dynamics, I see the US dollar maintaining its status as the global reserve currency. Especially as the euro falters and again, JPY is just imploding, and we'll talk about that in the segment 5. But these are some of the continuous issues we see. Central bank assets, as we were saying, have just been straight up. So since 2008, we've continued to see the Fed act at a very loose level, and you can see that big pivot up, which is the dark blue line, and then it's continued to trend. We had some light tightening as we got into the beginning of 2019, and then obviously that strong pivot higher. But somebody on Twitter brought up a great, I think a Philly fan is the Twitter handle, and I enjoy our conversations. I can't support the Philly side of sports, but he brought up a good point because he said, if you remember back during quantitative tightening when they were starting it, the repo market broke. And now the repo market is bigger than it's ever been, and we're tightening. Like, is that going to lead to something similar? And then here, and I think it's a great point, because will it? I think the Fed is aware of it, and they're going to try to alter that. But, there's a lot that is going to be considered as we go forward. But even though the Fed has been doing QE, look at the ECB, look at the BOJ. And remember, the Bank of Japan has been doing this since 1998. And now they've come full circle with the yen weakening against the dollar to levels that have not been seen since 1998. So after all of this easing, they have completely round-tripped, and here we are. And again, this is when it's all coming to a head, as consumer confidence and consumer spending in the developed world continues to weaken on the confidence side, and spending has been able to hold up, coming back to checks being printed, support being issued, and now we're starting to see that dry up, which is why we see that spending also falling. Now, container freight rates have continued to weaken, but look at the manufacturing PMI new export orders. And the new export orders is what we continue, and we've been talking about has been weakening. And one of the things is we've been saying this is the leading indicator, and then we're going to start to see the PMIs falter on the manufacturing side in the ASEAN nations and in other places, and we've now started to actually see that drop off. And we think that that's going to continue to accelerate, again, based on the advanced economies, flash, new export orders, and what that means for the global markets. So that is then when we look at rates, rates in general. So the global cycle is continuing to slow, and technically you should see the DXY slow down. You should see some of the weakness start to come in, but there's such a unique situation right now, which is why we've seen the DXY, which is just the US dollar, kind of hold in even as the global cycle has gotten hit. And if you think about where it was when the DXY stayed strong was 17, 18, but now think about the amount of debt that there is today, even versus what was there in 17. And that's, again, this disconnect that we continue to see. And think about where inflation is globally now versus 18. We're looking at inflation that is at levels that haven't been seen in decades. And a lot of countries rely on dollars to support that, or at least, mitigate against it, keeping a lot of these things coming through. And then the last chart looks at 5 largest interest rate return drawdowns. And this is where we see more pressure when we're looking at drawdowns, when we look at these sales, because people are looking to take risk off the table. And this is something that we continue to see as a hindrance to growth, and realistically going to accelerate that decline when we look at global economic expansion. So that's what we have here on the global side. In the next segment, we're going to go deeper into the U.S. and what we expect for the Fed, and then what is happening to the consumer on a real basis.